Welcome everyone. Welcome to this episode of Market Wrap. I have with me Mr. Pankaj Pandey. And interesting week once again. The Nifty gained almost 1%, but for those who are investing in mid and small caps, it didn't really feel like it that Nifty did gain 1%. Sir, what's happening and what's the outlook right now?
Yeah, hi, good evening, Ishu. Yes, Nifty has reclaimed 25,000 levels this week, gained about 1 odd percent. And like you said, something similar did not happen in mid caps and small caps. Largely, see, compared to global markets, we have done well. Sectorally, what we have clearly seen is that the interest rate sensitives, especially the financials and auto, did very well. Pharma, because of fear of possible tariff by US, underwent some profit taking. Now, when you look at the mid cap and small cap, we also need to understand that from the April lows, while Nifty is up about 15, 16 odd percent, the mid cap is up about 28 odd percent, and the small cap is up about 30, 35 odd percent. So there, the rallies have been bigger, and which is why a index like mid cap has corrected by about 6 odd percent. Last 5, 6 weeks, what we are clearly seeing is that Nifty is consolidating in this range of about 700 points, say between 24,500 to 25,200. And with it closing about 25,000 kind of a levels, our sense is that if geopolitical tensions do not sort of escalate, then it is very much possible that 25,500 would sort of be the next level to sort of look at. But till that time, I think I'll put the consolidation zone of 24,500 to 25,200 remaining intact. And I think, like I said, overall sense is that whatever the kind of a decline you are seeing, so for example, Nifty has corrected only 3 odd percent from a 15, 16% kind of a rally from April lows, and mid cap about 6 odd percent from 28% kind of a rally on the April lows. So all these are very shallow corrections, and we feel that uh, overall, when you sort of look at both these indices are again above 50-day exponential moving average, haven't really corrected with the kind of rally. And which is why I feel that this kind of a geopolitical turbulence, I think, is a good entry point for someone to sort of again look at entering the market. So we are quite constructive in the market. And I think a key monitorable again would be to look at geopolitical issues, especially Iran, Israel, and also the crude level index. Because crude is at $78. Our sense is that this is a resistance level for crude. So ideally, it should sort of come down. And dollar index continues to sort of remain weak. And since July 9, the deadline is approaching, so any kind of a development on the bilateral trade between India and US also would be a key event to watch for.
Right, sir. Sir, I think US Fed also announced its policy, its rate. It didn't really cut the rates this time, but I think it's planning to. What is happening there, and how do we read that?
Oh, yes. So when you look at Trump was expecting 200 bips kind of a rate cut, so clearly disappointed with the Fed not really cutting the rates. Policy rates are unchanged at 4.25%, and this was largely the expected view. What Fed has highlighted is that there could be a possibility of about two rate cuts this year and possibly one rate cut a year after. But in general, the Fed is quite concerned about inflation, and they would want to watch the progress on the trade agreements and also the effect of tariff. Just to sort of highlight, the tariff on steel is still about 50 odd percent. So obviously, it's a very basic item. Somewhere down the line, it will start to sort of impact inflation, and which is why the Fed expects the core inflation to inch up towards a 3.1%. Earlier projection was somewhere about 2.8 odd percent, and I think GDP growth rate also has been revised. So I think Fed is looking to do more of a wait and watch and let the sort of inflation unfold and the kind of damage this overall uncertainty does to the overall US growth rate. So our sense is that July meeting also nothing much is going to happen because most of the recent economic data which has come out from US is giving a mixed picture. And I think what is also not helping is that since the crude oil prices have gone up to 78 because of this conflict in the Middle East, So somewhere down the line, this is also not going to help in the US in terms of managing inflation. And I think the other fact is that overall, the US continues to sort of witness uncertainty. I think for us, US market not doing so great is good for us because somewhere down the line, I think one worldview was that US market is exceptional and which is why come what may, whatever happens, US market will continue to do well. I think that notion is sort of is being put to test, and which is why we feel that any kind of a weakness, incremental weakness or persistent weakness in US is good for emerging market, including ours, and that overall sense is that that is going to sort of lead to higher inflows. So unless something dramatic happens in US and which leads to market correction, I think most of the domestic macros are favoring us, and I think US not doing so well is also good for us. It will lead to better flows.
Absolutely. So let's talk about credit growth. I think RBI's recent print has highlighted again that it has moderated further. How do we see this?
Oh, yes. So when you look at the May end data, the credit growth has come to about just under 9 odd percent. And this is the lowest level of credit growth what we have seen in the past 3 years. And I think largely this is coming from the perspective that banks have been prioritizing risk containment over aggressive expansion, and which is why we are seeing this kind of a subdued growth. Now, overall sense is that while this growth number is definitely weak, but whatever policy interventions have happened in the last few months, I think those will start to sort of take shape going forward. And which is why I feel that the credit demand is expected to gradually revive over FY26. Look at 100 bips kind of a CRR cut, which is expected to release about 2.5 lakh crores of durable liquidity. Then I think central bank is also sort of saying that whatever stress was there in personal loans and credit cards, that is also sort of peaked out. So these are high yielding segments for banks. And our sense is that FY26, the credit growth would revive to about 10 to 11 odd percent. And further in FY27, it is expected to sort of accelerate to about 12 to 14 odd percent, because any policy measure usually takes some time to sort of let it affect being felt. I think what you are clearly seeing is the kind of a previous policy measures which the previous governor had taken, and that sort of led to a pivot more towards risk containment rather than sort of growth. I think the current governor is clearly sort of in favor of a better growth, and which is why I feel that while this is one of the lowest growth, but it is expected to become better in the second half and even better in FY27.
Absolutely, sir. Sir, I think RBI has also come up with some new guidelines for project finance. How do we interpret that?
So, when we sort of look at again compared to the previous governor, this governor has been quite growth focused. So earlier, the previous governor had or RBI had come up with a draft proposal wherein 5% of the provisioning was required for projects in the construction phase. Now, this governor has largely done away with all of that, and the provisioning which will be applicable is 1 to 1.25 odd percent. So basically 1.25% for commercial real estate projects such as malls and offices, 1% for residential housing, infrastructure projects, and 0.4% for other project loans. So I think, like I said, it's a clearly step towards revitalizing the infrastructure credit, and this is offering a significant relief to the lenders, because if you have to sort of do a provisioning of 5%, that means a significant amount of money has to be sort of allocated. And so from that perspective, this this been implemented, this would have overall increased the project cost and also could have made a lot of projects unviable. So I think governor is clearly sort of highlighting or realizing all of this, and which is why we are seeing this change. And I think the good part also is that this is not applicable to existing projects. So projects which have achieved financial closure before 1st of October 2025, I think they will remain under the existing regime, and they'll not need to sort of adhere to this provisioning norms. And then there has been some tweaking in the date of commercial operations as well. because that is the date which determines the asset classification. So I think a lender has been allowed to sort of a period of up to 3 years for infrastructure projects and 2 years for non-infrastructure projects. So that way, I think it is pretty positive for infrastructure lenders, and I would highlight some of the companies like say PFC, REC, again owned by PFC, and IREDA, which are expected to benefit. Now, IREDA is one of the companies which is there in the project financing side, especially in the renewable energy. And this company is looking to target about 25-30% kind of a growth rate with ROAs of nearly 2% odd. We like this stock, and we have seen movement in these stocks also. The other one which would benefit is PFC. PFC is a company which is focused on distribution and power generation side, and they're talking of 10 to 11% kind of a AUM growth. So I think this is another company which is going to benefit. And so from that perspective, I think whatever incremental measures you sort of keep getting from the RBI, I think are a step in the direction of better growth, be it credit growth or be it better economic growth.
Absolutely. Right. SBI also announced a savings rate cut. How do you look at it?
So yes, a lot of things are turning positive for banks. So SBI, we all know, is the biggest lender. Now this bank revisiting their saving rate has implications for the entire sector. SBI already had 2.7% kind of a interest rate on the saving balance below 10 crores and 3% for balances about 10 crores. And which is why a lot of these private sector banks reduce their saving rate to those levels. Now, SBI has further reduced the saving rate to about 2.5% across all retail deposits. Now, this is giving a further headroom to private sector banks and banks overall to sort of lower the saving bank rate. And mind you, for a big bank like SBI, they have lowered their fixed deposit rate by nearly 70 bips. So which means that clearly the bank is looking to protect the margins, and if a big bank like SBI is doing that, a lot of banks are expected to sort of follow suit. And which is why we are getting confident that going forward, a bank which witnessed a margin pressure of about 11 to 12 odd bips in FY25, something similar was expected in terms of margin pressure in FY26. But all these measures are senses that going forward, second half FY26 onwards, the banks are not going to witness that kind of or margin pressure at all. So from that perspective, I think BFSI is one category which is looking very good, looking to sort of perform a lot of sectors. So I think we are turning very positive in banks in general.
So Siemens Energy India also listed recently. Any highlights, any views on the stock?
So we have been highlighting this that this demerger is going to create or unlock value, and prior to demerger, share prices were trading somewhere about 5,000, and post demerger, the combined value is somewhere about 5,900. So value unlocking is to the tune of about 18% odd. Now, Siemens Energy India is one segment. Is the company which has been listed, and we feel that this company is going to be a big beneficiary of the distribution, power transmission and distribution capex of nearly 9.2 lakh crore, which is what the government has envisaged. Because this company is into power transformers, then it has got traction transformers. On the generation side, it has got power generation turbines. And we feel that this company has already been sort of doing well earlier. So for example, FY27, they were making margins of about 16 odd percent, profit margins of 7 odd percent. And I think order book compared to last time has improved to about 15,000 odd crores, which is 2.5 times book to bill ratio. So this is one of the again transmission companies which we feel that can grow at 15 to 20% CAGR, and profit growth could be even higher at 25 to 30 odd percent with good return ratios. And so again, it's a sort of a portfolio stock. Relatively of the two, we prefer this one because of the better macro opportunity, which is about to unfold.
So Trent was also in the headlines a few days back for its investor day. What are the key takeaways, if at all, for us?
So Trent again holds the glory for the most expensive consumption stock, but I think this is also it is also a fact that this company is delivering phenomenal growth. I think FY19 to FY27 they have grown their revenues by 37%, profit by 52 odd percent, and they have one of the highest average revenue per square feet. And so they have literally cracked the overall template of the value fashion category, and which is why now the base has become bigger. So which is why this company is talking of 25% kind of a growth rate in the medium to long run, which again is a pretty good growth rate, because for Nifty, our own estimate is a growth of low double digit kind. So this is one company which is going to obviously grow at a much higher rate. And again, they are looking to sort of open about 200 to 220 stores on a regular basis. In the next 2 years, we expect about 30% kind of a growth in revenues, and margins again is one of the highest. So we feel that this company will continue to do well. I think any kind of an incremental weakness in the stock is an opportunity to buy. But since the stock is a bit expensive from a valuation perspective, so which is why this stock needs to be bought from a longer term perspective, where you can't really be buying a stock with a 1 year perspective, because stock being expensive, it is very much possible that it might witness price or time correction. But I think growth outlook is clearly the highlight from the investor interaction, and which is why I feel that this stock will continue to do well, but the time horizon or investing horizon needs to be longer.
Absolutely. So Zinc India also announced another massive expansion of its capacity. Any impact that we see on Vedanta because of this?
So we continue to like Vedanta because, one, I think dividend-wise they've declared a dividend of 7 rupees. Now on the business side, what they've done is that zinc is a very important segment for them. Now this is one segment which contributes about 20% of their top line and about 40% of their overall profitability. Now, on the zinc side, they've got a capacity of about 1.2 million tons. About zero point 0.9 is zinc and balance is lead. What they've said is that they're going to spend about 12,000 odd crores in expanding the zinc capacity from 0.9 to about 1.2. So effectively, total capacity goes to about 1.4. That is the phase one expansion. And then the 45 days, they'll come up with a phase two expansion, which will increase their capacity from 1.4 to about 2 million tons, but obviously this will take a good period of time. Now, this company or this business is expected to do very well, largely because on the zinc side, they are one of the lowest cost producers. They've always been maintaining a EBITDA margin of about 50 odd percent. So from that perspective, in commodity, it is extremely important that the player is lowest cost producer, and which is why it commands one of the highest multiples. Our sense is that overall, this is quite beneficial for a stock like Vedanta, and which is why I feel that this stock should do well, both from an earnings perspective, also because on the aluminum side they are doing a lot of integration. Zinc business is doing well, and we also know that the silver prices started to sort of move up. So from that perspective, also silver production is expected to go up, and I think which is also going to improve their profitability. All in all, I think things are working well for this stock. We have a target price of 600 on the stock.
Right, right. Sir, another interesting piece of news this week was DLF clearing an inventory of 11,000 crores in just 1 week. How do we take this?
So yes, I think DLF continues to do very well, especially in the Gurugram market. So they have guided for pre-sales of about 20 to 22,000 odd crores for entire FY26. And with one project itself, they've sold about 11,000 odd crores. So they've literally achieved 50% of the guidance. So it is quite likely that they're going to sort of outperform their own guidance. And I think pricing wise also they've got a good response. Why we say this is that this Privana North, where they've sold about 4.5 million square feet. Now the realization was somewhere about 24,000 per square feet. The previous Privana West, I think they sold somewhere about, I think, closer to 3 million square feet. and I think realization was about 18,000 odd. And on the west side, they sold somewhere about, I think, 4 million square feet, and the realization was 19,300. So they have got better realization, higher volumes from this, and good response again from NRIs, because NRIs, they were under 30% this particular phase. For North, the NRI contribution is about 30 odd percent. And why we say they should be easily able to beat is that they are going to launch about less than 1 million square feet in Mumbai. And then there is a new phase for Dahlias, and then there is the Goa project being planned. So clearly, I think the premium leg of the real estate market continues to do well, and obviously DLF are champions of that. So from that perspective, they continue to do well. This is one of the top picks in the real estate sector with a target price of 1,000.
Right. Sir, we just talked about, of course, Siemens Energy India IPO. There's another IPO coming up, which is HDB Financial Services. How do we look at it?
So I look at it from the lens of HDFC Bank. Now, say it's a subsidiary of HDFC Bank. They're going to raise about 12,500 odd crores, and HDFC Bank is going to offload 10,000 odd crores of share. And since these are classified as NBFCs in the upper layer, so they are supposed to come up with an IPO, and which is why we are seeing this IPO. Now, compared to the overall, the pricing is on the lower side at 700 to 740 because earlier, the previous markets, I think we have seen these at higher prices. But any which ways, I think this is one of the NBFCs which is retail focused, typically focused on auto, land, and MSME, has got an AUM of about 1%. ROA stands at about 2%. At the best of the time, ROAs were higher, but now asset quality is sort of stable. Now, valuation-wise also is at about 3.4 times. Again, we'll sort of discuss the IPO separately, but from a HDFC Bank perspective, it does not really move much of a needle. From a valuation perspective, it could be contributing about 4 to 5 odd percent. So between the two, if I have to say, probably we continue to like HDFC Bank more than NBFCs. But yes, overall, again, it's a big IPO which is expected to sort of come by.
Right. And finally, sir, it's time for the hidden gem of the week. Which will it be this time?
So Vishu, the stock I am recommending is Allied Blenders and Distillers with a target price of 495. Now, the reason for liking this stock is because of the fact that this stock is banking on the premiumization strategy to drive double-digit growth and margin uptake. Now, overall sense is that the prestige and above category for this is expected to inch up to 45% of their overall turnover from about 37%. And this is will be anchored by the fact that 18% of the growth is expected in the prestige and above segment. And that will lead to about 13% kind of a growth in the overall top line for the next 2-3 years. And the other thing is that this will also sort of lead to better margins, because what we have clearly seen is that from FY24 to 25, this company has seen a 500 bps kind of a margin expansion. And next 3 years, we would expect the margin profile to further improve to about 15%. And whatever launches they have done in the recent past, they have done very well. So those have become $1 million cases brands. So from that perspective, we feel that this stock will do well. On top of it, I think the UK FTA deal also is going to provide additional benefit to them, because they'll be able to import bulk scotch and will be able to sort of blend it with their premium whiskey brands. And I think the other fact was that the stock was struggling of late was because they had a lot of receivables from Telangana state, and they've started to get money. I think about 400 crores is what the Telangana government owed to them. And which is why the debt levels has also sort of come up on the books, and that our senses will start receding. So I think overall growth of 13% in revenues with better margin uptake, we are expecting nearly 30% kind of a bottom line growth, and which is why I like this stock with a target price of 495.
Absolutely. Well, that was really insightful. Thank you so much, Pankaj sir, for that. And thank you so much, everyone, for watching. We'll be back next week. Until then, if you have any questions, please put them down in the comments. Thanks again.
Thank you.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.